Ray Dalio is one of the richest and most popular investors in the entire world with a net worth of almost $20 billion and is the founder and portfolio manager of Bridgewater Associates, which is also one of the absolute largest hedge funds in the world with $140 billion of assets under management. And this most recent quarter, while the stock market was crashing and the Nasdaq is still down over 30% as of today, well, Ray went out and he made some giant purchases in several different stocks. So in today's video, I'm going to show you the 5 largest purchases that he made in individual stocks. I'm going to give you my opinion on each one of those stocks, and I'm even going to rank them from best to worst just to make the video even more fun than I already think it is. So if you enjoy these type of videos where we look at what the biggest, richest people are buying, let me know down in the comment section or hit that like button. That lets me know you want to see more videos like this. But thank you for all the support. Please subscribe if you haven't already. But let's go ahead and jump straight into this list. All right, and counting down here from smallest to largest, stock number 5 that Ray purchased this past quarter was none other than Microsoft, ticker symbol MSFT, which Ray has increased his position on, by the way, in each of the last 3 quarters by giant amounts, with a 156% boost this latest quarter, bringing his total stake in the company up to a whopping $74 million. And I gotta say, guys, I absolutely love these moves because I've been buying some Microsoft stock myself too this past year, as it is currently going through what I would say is really the largest crash that I've ever seen in the stock for what is normally a very strong and stable performer. But as it stands, Microsoft is now down about a third of its entire value. And sure, there's good reason for this. Of course, the macroeconomy is really terrible right now, and as we move past the pandemic, we've seen demand for computers really fall to dramatically low levels, with PC shipments declining by 20% just last quarter alone. And that's probably going to continue for some time with, the economy opening back up, people returning back outside, just a lot of less demand for these computers. And that's not only caused Microsoft's revenue from Windows licenses that they sell to OEMs to fall by negative 15% in their most recent earnings, which is the biggest drop, by the way, that they've seen in 7 years, but it's also causing their overall revenue growth as an entire company to plummet from 11% growth last quarter to only 2% expected next quarter, which is really scaring investors into selling out of the stock. However, out of this weakness, I think may come a great buying opportunity, as Microsoft is one of the largest corporations in the world that is already doing almost $200 billion in sales, and over $70 billion goes straight to the bottom line, just net income profit alone. And that was also growing at a rate of almost 20% per year through the pandemic when looking at their growth rates. So having a correction year right now should not only be considered normal, but it should really be 100% expected. Yet investors are selling out of the stock as if they never saw this coming. And look, I say correction, but really the business is not even in decline. The growth is just slowing down to 7% this year before it recovers to a double-digit 13% next year. And I'm sorry, but at this massive size and still putting up double-digit growth, that's a buy all day. On a GAAP basis, they're only about 5% more expensive than the sector and close to 20% cheaper than their own 5-year average, with also a small but very high growth dividend of over a 1% yield, with a tiny payout ratio, a double-digit growth, or about a double-digit growth rate, and almost 2 decades of consecutive growth ever since they started paying it. Plus, you get one of the most dominant businesses out there with their Windows operating system and office productivity software really installed in virtually every computer in the world. They have a growing presence in cloud that already has the second most market share. All the work they do in artificial intelligence, that's only going to get even bigger over time. And an innovative approach to gaming through Xbox, their streaming Game Pass service, and cloud gaming with xCloud. Not to mention an upcoming acquisition of Activision Blizzard is really going to make them a giant, gaming presence. May make them, number one, number two biggest gaming company out there. Now, personally, I think Microsoft is a buy on every dip, and when looking at how to rank them here, I'm going to have to rank them as number one on the list until I see anything better. By the way, Microsoft is also my number one largest stock in my own portfolio. So just FYI, just to be transparent here. But anyway, moving on to stock number two, that's going to be another stock that I happen to own myself in Google, ticker symbol GOOGL. And I hope great minds think alike here because, like I said, I do own this one myself too. But Ray has been buying this stock in very large amounts these past 2 quarters, increasing his total stake in the company by almost 50% last quarter, raising the position up to over $140 million. And you know what, guys, believe it or not, as much as I love Microsoft, I actually think Google is even better, an even better buy at today's prices. Like Microsoft, this is a stock that rarely ever dips, but it's currently going through the largest crash that I've ever seen, just like Microsoft, and it's already down more than 35% from its highs. And at these levels, Google is now trading on a PEG ratio basis when you look out into future growth that is not only 25% cheaper than their 5-year average, but they're almost 10% cheaper than even the sector. That's crazy. This is a PEG ratio that is much lower than, their average and the sector. And I've been screaming to you guys all year long that this is a historic buying opportunity because there is no way that the world's market share leader of digital advertising, search with Google, browser with Chrome, mobile OS with Android, video streaming with YouTube, navigation with Maps, email with Gmail, and even the third largest cloud platform to go along with all of it. There's no way that this should be trading anywhere close to these levels, and especially even cheaper than the sector. That just doesn't make any sense for this massive behemoth that did even more sales and profits than even Microsoft last year and is still managing to grow by a double-digit percentage. Don't get me wrong, Microsoft has much better margins, and I would actually prefer them over Google if the valuations were the same, but they're not the same. And at its current discount, Google stock takes the number one spot for now. I think it's a better buy. So I'm going to move Microsoft down actually to number two, even though I love Microsoft. All right, guys, coming in here at stock number three, though, that's going to be Mondelez International, ticker symbol MDLZ, which Ray has also been purchasing very steadily in each of the past 5 quarters. But this latest one, he just decided to go ham on it, increasing his position by over 200%, bringing his total stake in the company up to about $190 million. Now, if you guys have never heard of this company, well, you probably have heard of their products or their brands, because Mondelez is a consumer staple company that is mostly famous for snack foods like Oreo, Chips Ahoy, Ritz, Triscuit, and Belvita cookies and crackers, as well as Trident's gum, Sour Patch Candy, and even Toblerone chocolate. In all, guys, this might surprise you here, but Mondelez actually commands the number 1 market share of biscuits in the entire world, with the number 2 market share of chocolate, number 3 market share of candy, and number 2 market share of gum to go along with it. So that is very large dominance from this company that I think most people, might have not even heard of that name, Mondelez, but again, you probably know their brands. Now, that strong branding has helped them put up some very strong financials over the years, doing over $3 billion in free cash flow every year with mid-single-digit revenue growth, high single-digit EPS growth, and double-digit dividend growth to go along with it. And one of the reasons why they're still able to grow like this despite their already massive size and market leadership is because they're expanding globally into emerging markets where they typically see about 3 times higher the revenue growth. Now, their dividend is also very attractive from a growth perspective, as it yields about 2.4% with a small payout ratio below 50%, a double-digit growth rate, and over a decade of consecutive growth. Unfortunately, though, that strong performance has kept the stock trading near an all-time high. So, at a time when so many other great stocks are trading at huge, giant discounts, Mondelez is actually 20 to 30% more expensive than the sector. And as strong as the business is, the single-digit growth for their sales and profits is just not high enough to justify that high of an expensive valuation, nor is the small dividend. So they easily go behind Google and Microsoft, and I'll put them in the number 3 spot for now. It's a decent stock, I guess, but not great for that valuation in my opinion. All right, moving on here to stock number 4, though, that's going to be a stock that I actually own myself, and that is the payments processing giant Visa, ticker symbol V, which he has also been buying in recent quarters with another giant increase in Q3 of almost 150%, bringing his total stake in the company up to over $216 million. And what can I say here, guys? Visa stock is almost a solid choice anytime, really, if you're thinking long term. Not only do they have the most credit cards in circulation at about half of the entire market, but they also see the most purchase volume run through their network at about 54%, which, by the way, has even increased over the years despite it already being in such a dominant position. And they can then charge fees on that massive amount of transactions, which has led to very strong financials over the years, with even their revenue growth rates being extremely reliable, very surprising for their size, at double-digit percentages in almost every single year. Even in 2020, when the global economy literally shut down, they still only dropped by about 5%. Granted, there was lockdowns, things like that, so they were able to collect money through online purchases. But that's the great thing about Visa. They can get money online, they can get money in person. There's different ways they can make transaction fees. And even after that 5% drop, they quickly recovered by 10% the next year, and then they grew a massive 22% the year after that too. Again, I know I'm going back and forth here, but we gotta be transparent here or reasonable. We gotta look at both sides of the argument. That giant growth that they saw was really after 2020, right when all of the stimulus money and the insane spending by the government started to flood into the economy. So that's why you saw such a giant growth rate for Visa. And that's now leaving us with a disastrous economy with really high inflation, really high interest rates, which has the potential to really collapse the economy, and it could send us into a deep recession soon. So if that happens, then yeah, I would probably think that the growth rates that are projected for 2023 and 2024, Visa will probably miss those targets, and then the stock could crash. So that is the risk there. And that's really the only reason why I'm not buying any more shares myself at this time. But I still think that it's a great long-term hold, because even when they do have a downturn, they typically tend to recover much faster than everybody else. So I really do like Visa a lot, and I don't plan on selling any of my shares anytime soon. Speaking of the stock though, it's always been a very reliable performer, and as such, it's only down about 16% from its highs. So it's not as attention grabbing as some of the other big names that have crashed much heavier this year, but it's still a bit of a dip there. And that's really left them with, I would say, a bit of a mixed bag in terms of the valuation, as they're about the same as the sector on a forward PE and PEG ratio basis, but more than 30% higher on a trailing or non-GAAP basis, but then also about 20% cheaper than their own averages. And even the dividend is a bit of a mixed bag too, as it has a tiny yield of less than 1%, but it's got some amazing growth metrics on it, like a tiny payout ratio, a huge growth rate, and about a decade and a half of consecutive increases. So it's not likely to get cut, it's only likely to get bigger over time. And here, that's why you can really see how this makes for a stock that, I think in my opinion, it's a little risky today, but I think over the long term, I think it's usually a good pickup, especially on dips. And right now, it may not be the biggest dip in the world, but it is going through, a double-digit percentage dip here as well. So you can kind of make of this what you want, but in terms of me having to rank it here, I would say it's got to go below Google and Microsoft, because those are much more attractive at today's prices, but I still like them ahead of Mandela's. So I'm going to put Visa at number 3, and I'll move Mandela's down to number 4. I think that's a very good fitting right there. All right, guys, finishing up here with stock number 5, we've got a dividend king. And this is none other than Johnson & Johnson, ticker symbol JNJ, which is a stock that I've always considered buying, but I've never actually pulled the trigger on it. Ray seems to be a lot more courageous than me though, as he's been steadily buying the stock by small amounts every quarter, and although he only increased his position by less than 10% this last one, it already makes up about 4% of his entire portfolio at an absolutely massive over $750 million. Now, the reason why I've always been interested in Johnson & Johnson is because of their massive size, their popular brands, and the reliable dividend. Now, in terms of brands, they not only own giant consumer staples like Band-Aid, Johnson's powders and lotions, Aveeno, Listerine, Benadryl, and Tylenol, just to name a few. By the way, I use Tylenol all the time whenever I get headaches. Probably not a good thing. I'm not huge on taking a lot of pharmaceuticals and stuff like that, but I admit I do use a lot of Tylenol because when I get headaches and stuff. But anyway, besides the point, apart from all of that, they also sell all kinds of different medical devices, and they were even one of the biggest producers of the pepperoni V-shot during the pandemic, although it's usually the least popular choice. But still, J&J is known for putting up giant financials every year, reaching close to $100 billion in sales just last year alone, with over $20 billion in net income profit to go along with it. Unfortunately, though, growth is not really what you get from this company, as sales are only expected to climb by a couple percentage points going forward as they continue to deal with the fallout of various lawsuits that have really damaged the company's reputation. Really, the best thing about this stock, though, is their dividend king status, as they have now raised their dividend for a mind-blowing nearly 6 decades in a row. However, at a 2.6% yield, I'm just not sure that's large enough to make up for the tiny growth and the slow-moving stock price that is only a little bit cheaper than the sector. I still like them more than Mondelez, but not nearly as much as I like Google, Microsoft, or Visa. So they're gonna have to go in the number 4 spot. Alright, so with that said, we have our final rankings here, and we've got Google at number 1. I think that's an absolute steal at today's prices. Microsoft at number 2. I think that's a very solid pickup. Great alternative choice to Google if you're looking for one, or even both. I think both are great choices. Visa we put at number 3. I think that's a decent long-term stock. Definitely want to be buying that on dips though if you can get it. And then J&J and Mondelez, I would say at number 4 and number 5. I just think there's much better options than those last two. During this current economic downturn, during this market crash, whatever you want to call it, I think there's much better stocks out there than those two. But, not bad choices though. It's just that there's better options out there. But what do you guys think? I would love to hear your thoughts down below. Let me know if you agree with my ranking. Do you own any of these stocks? Are any of these up on your watch list? Are you considering any of them? I'd love to hear your thoughts down below, and let me know what other, rich investor or portfolio manager or hedge fund you'd like me to take a look at next. I'd love to hear those recommendations, and I'd love to make those videos for you guys. So thanks again for stopping by, everyone. Hope you're all doing well. I'll catch you in the next one. Take care. Bye-bye.